The debt ceiling has come and gone. We're going to talk to Peter Hug on this edition of For Pete's Sake, and we're going to see what he has to say about it. Stay tuned. Peter, thank you for joining me today.
You're welcome, Alex.
So, Peter, it came down to the 11th hour. A deal was finally reached, extended 3 months. Was this the sort of deal that people were looking for, that people were expecting?
No, I don't think so. I made a comment to my trader this morning. I wish this was the 1980s. My commentary would have contained a bit more flowery language than it did this morning. I think it was an asinine deal. The world is right now not healing well, and Europe is still in having some major restructuring issues. China is slowing down, and in that context, when people get nervous, they viewed the U.S. dollar as a safe haven play, and generally bought short-term treasuries, usually 90-day yields. With this kicking the can down the road for, quite frankly, 90 days. It created some nervousness in the market. First of all, the fact that it went to the 11th hour and 59th minute was an issue that was a joke in and of itself. But now, if you picture yourself being a European, the Greeks again came out for a third handout yesterday. They're looking for some safety. So where do you park your money? Well, let's park it in short-term treasuries. Well, if you buy 90-day T-bills, there's a possibility, very slight, I'm not suggesting they're not going to pay their debt, but very slight that at the end of the year, when those T-bills mature, we're going to be in this same mess again. And maybe this time they won't increase the debt limit, and maybe there might be a default. Again, it's always maybe, could be, but the fact is it creates the nervousness. It persuaded people to sell the dollar overnight, and you have the result move in the precious metals as a result of it.
Now, throughout the debt ceiling debates, the negotiations throughout the week, especially yesterday, we didn't see too much activity from gold in the positive or negative. But this morning, as we've seen, gold just skyrocketed up. Analysts say that was part of, based on Chinese credit agency, lowering credit rating for the U.S. You have Fitch, who also threatened to do the same earlier in the week. If you look back to 2011, right after the debt ceiling debate negotiations were settled in the last hour, S&P promptly downgraded the U.S. So, what does all this mean for gold prices moving forward?
Well, it just adds fuel to the fire. I'm not taking the Chinese story with too much seriousness, but the concept that the gentleman in Washington push this to the 11th hour and 59th minute, but everybody in the market, by I mean everybody, the traders fully expected some kind of a deal. They couldn't imagine that these guys would go and go over the edge. But a lot of that was priced into the precious metals market. The market started dropping about 3 months ago on the basis of the Fed tapering. So that took the edge off the markets as people perceived higher interest rates. So the markets were already in a soft tone. The fact that the deal might not have gotten done added the final selling pressure, which took gold down to major support the other day on Tuesday of 1255, where we suggested there'd be significant support. So once the deal was announced, again, you could go through the old adage that it was buy the rumor, sell the fact. But the deal being announced had been priced in. Had there been no deal, obviously, all bets would have been off the table. But when the deal was finally agreed to, unfortunately, it was in Asian hours, and the market was very thin. They analyzed the deal, realized that in 3 months from now, we would be exactly in the same position we're in right now. And they bought the metals and sold the dollar.
Right, so you mentioned the Fed, and I'm glad you did. Tapering is always the buzzword that we keep hearing. I know what camp you're in with, you don't see it until 2014, but is there any possibility that we could see tapering from the Fed in 2013?
Well, I've been on record since, I can't remember when, October of 2012, suggesting that the Fed was going to keep their foot on the accelerator at least through 2013. I am now absolutely convinced that the Fed is not going to do anything at least until March. First of all, Yellen comes in January. Her actual first Fed meeting, chaired meeting, doesn't occur until March. given the fact that the Fed is, the government has shut down in the United States, is going to probably take a 0.5 point off GDP growth in the fourth quarter of this year. I do not see an acceleration of the economy for the balance of this year, and this has given the Fed perfect ammunition and cover to continue their bond buying. And if anything, I would suggest that the surprise would be that the Fed may need to increase their bond buying, especially if there's an issue at the end of the year.
All right, Peter, with all this in context now, what kind of ranges do you see for gold moving forward?
1325 is still key for me. If we can get through 1325, I think the high, well, not the high, but 1370s are certainly in play. This market, in my opinion, now needs to be bought on dips. I was in the camp that there was a possibility of the 1255 breach, which would have indicated an 1190 test, this year's low. I think that's off the table now with what's happening over the next 2 or 3 months. I cannot imagine major dollar strength occurring in this time frame. So that takes one catalyst off the market for bearishness in the gold market. I do not think the Fed is going to taper at the October meeting. That takes another catalyst off the table for a bearish sentiment in the gold market. But what we're looking at here is fear, which is beneficial for the gold market, but we have to be very careful here, because if the stock market starts to get hit, and I don't mean drift lower, but get hit in a big way, people are going to run to cash, and the initial reaction is going to be to liquidate metals to raise that cash. So there's a lot of conflicting influences right now, but my tendency would be to buy this market on the dips at least through the end of the year.
All right, so I guess the next 3 months are just buckle up and go along for the ride?
You've got to trade the ranges. I mean, if gold breaks through 1325, you've got to get in long and look for an acceleration to 1355 and then 1370. On the downside, 1255 is major. That's the level that needs to hold, and I suspect it will. But if we breach that level, then the lows of this year again come into play. I do not see that happening, though, between now and the end of the year.
Sounds good, Peter. Thank you very much for speaking with me today.
You're welcome, Alex.
And thank you for watching this edition of For Pete's Sake. Remember that Peter will be speaking at the Metals and Minerals Conference in San Francisco, November 25th and 26th. Keep an eye out for that. Also, if you have any comments or questions, please don't hesitate to send them to newsfeedback@kitco.com, or you can find me on Twitter @Alex_Letourneau. Have a good one.